Good morning, everybody. This is Dennis Woven with the Active Trend Traders. Joining us from Dallas, Texas is Mike Traeger. Mike, how you doing this morning?
I'll say good morning, although it's afternoon here now.
Okay. And Michael Bishop is somewhere off in Europe, somewhere doing his, man, I tell you, this guy takes advantage of his holiday season. And he is, last I touched base with him, is bicycling down by Nice or something like that. And so he'll plug back in, I guess, when the weather in Europe turns bad. But anyway, good for him. And so, hey, I want to remind everybody that all the materials we present are for training purposes only. Traders should always paper trade any new method prior to the risking their own personal capital. Hey, this morning I'm going to start off with just something a little bit different than what we would normally do. And we had a request from somebody to take a look at Grub. I think Grubhub. Grubhub has been on the IBD 50 list, I think, for a couple of weeks now. Had a real nice move after earnings, of course. Broke out and has continued to press higher. The question was having to do with, okay, it broke outside the Keltner channels, and now it can do, one of three things at this particular point. It is extended away from its moving averages, so wouldn't be looking to buy at this level. As you can look back in the past on Grub, it does have a habit of putting in fairly nice patterns to be able to, to provide potential entries, and they're always pulling back either to the lower side of the Keltner channel or at least back to the, 8, 20, 50-day moving average combo. And so for me, if I were looking to invest in Grubhub, I would be looking for a pullback into the moving averages. They're really extended from its weekly moving averages, and as you can see, the TSI and the momentum has just skyrocketed. We are actually back up into an old resistance level and resistance zone right around the 40 level, and so I think Eric asked about this, and yeah, Eric, I'd be looking for it to, give me a little bit of a pullback and then a bounce higher from that. And it could be one of two types. It could be basically go stagnant for a while after this long, or do a nice pullback. The 20 week moving averages, when they catch up with that, potentially around the 34 level, or 34 to 35, that's when I'd be looking to get into this particular trade. If we throw a real quick fib on this, let's see, what do we want to do here? Yeah, let's just do a straight fib retracement. We pop down to this swing low here. Now, there's a couple of ways you can do this. This was a major swing low. Pop it back up to the tops. And a 23% retracement would bring it down to 35. 34 would be inside the 38 and 23% retracement, which somewhere in there, if this is going to maintain, I mean, this was a huge buying opportunity here, well, buying volume here, and so that's what we would be looking for. So Eric, I hope that answered your question. The other couple of things that it can do, it can in fact continue to skirt right along that Keltner channel and the moving average envelope. It can just basically kind of continue to skirt that, but at some point the moving averages have got to come up, catch up. It's got to do some kind of reversion back to the mean. So I hope that is beneficial for you. You betcha. You're welcome. And so now back to where we were here. I'll lay on SPX, and that's a good way to layer into your watch list. You know that Grubhub has good fundamentals, strong fundamentals per IBD, and And so once you get that on your list, then it's just a matter of patiently waiting for it to, you know, to present itself in a position where you say, okay, I'm going to risk doing the trade right now. Michael's not with us today, so I won't do his disclaimer. I really enjoy doing my midweek market sanity check, the training sessions for premium active trend trading members. We both do this live, but then it is also recorded. You can find it on the website under training videos. This past week, it was a really good session. We then it was about finding great stocks and then the tools to be able to analyze the stocks that you're looking at. And a topic for this week, fixing bad trades. Then I want to thank DC sent us a really nice email back in May, talked about the active trend trading service. This member had gone out and was, looking at another source, but the expense was so great. She goes, I don't understand, why they're charging so much for what they do, and they were just recognizing the true bargain that active trend trading is with the training sessions and the alerts and all that kind of stuff. So market update, August 5th. The old song, remember the old song, Mike, let me take you higher. I can't remember who sung that song. Do you remember who sang that song?
It's right on the tip of my tongue.
Yeah.
It was
Sly and the Family Stones.
Family Stone, thank you very much. That's exactly right. And unfortunately, I am old enough to remember when that came out.
Yeah, it was back when we both had color in our hair,
And more of it for there to be color in.
That's true. But this market continues to defy gravity. The S&P pushing to new highs. Nasdaq, it broke out of last year's high today. We'll see if we get a close above that level. And then the Russell also moving higher back into the zone around last year's high. Outside influences for this week. Okay, one, the jobs report came out with very positive, well, they called it very positive. It was about 200,000 new jobs were added. It's very interesting how it seems like, Mike, and I know you and I have discussed this, how it almost seems like, the Fed and the people who, Department of Labor, are just working really hard to condition people to accept less is better from what it was back when we would have really strong economic recoveries and all that kind of stuff. But this week, earnings, hey, the big names are basically out. Priceline reported last night. They blew away earnings. It jumped up about 8% this morning. We do have, still have some negative divergence going on the charts, but no real market reaction to that negative divergence yet. And then we're getting some divergence also between the daily and the weekly charts. The weekly charts are looking more, are looking like they're at a point where they would like to turn over. The weeklies have basically worked off the recent oversold condition and are now in the process of rebounding. And so it's basically, we got this really short little pullback on all of three of the indexes. S&P pulled back to its 8/20 weekday moving average and rebounded from that. Same thing with the Russell. I don't think the Nasdaq quite made it back there, but really, I mean, the market is still overvalued. But it also is still in gear to continue its rally mode. And right now, Mike, I'm not seeing any catalyst out there that, could potentially whack this market and take it down. Are you?
No, I mean, the most recent catalyst that I thought do that was, the Brexit thing,
Yeah.
and that resulted in, 2 days of hard selling, which immediately, I mean, it just slammed into a bottom and immediately bounced right off the
Yeah.
bottom. And
Yeah.
we know that was central bank intervention, and it continues to be the central bank influence on the markets. But as far as events that might produce a more protracted downturn, I mean, that was it, and that didn't happen. And I agree that there's nothing else on the horizon right now that might derail this.
Yeah, what's really interesting is the fear that, there basically is almost no fear in the marketplace, or it's very slight. I mean, the VIX this morning is dropping down to new lows, and so Gino mentions that oil could take it down, and that certainly is a possibility. What I sense, it may not be just one particular thing that comes up and whacks the market, but it may be a combination of other things that are weighted onto the market, that could basically put the cap on it. But at this point, hey, we're pushing higher, and that's the direction the market wants to go, and didn't get the great pullback that I was orderly and smooth pullback that I was looking for on the market, but we got the bounce, and those are really challenging to try to jump into. I showed you the percentage of stocks above their 20-day moving average on the NYC. Last week we were sitting up here about 65. The market was pushing up higher. Well, guess what? The market is pushing up even a little bit higher today, 28. It's up. The spiders are up above 218. The percentage of stocks above the 20-day was starting to bounce. However, Mike, let me go back. Mike, you basically were pointing out, and we were pointing out on Wednesday, is that the market's making a new high, but the number of stocks that are going with the market to a new high is in fact divergent from the making the new highs. But again, the divergencies are not working out in any type of downside pressure yet. Yeah, any comments there, Mike?
I was reading just yesterday about this whole topic, this whole issue. I mean, what's driving the market, and we know there's a lot of evidence that central bank buying of individual stocks and ETFs has been the primary factor driving the market over the past 5 weeks or so.
Yeah.
And I saw an interesting yesterday, and it was about the Swiss National Bank, which has a good portion of their balance sheet invested in U.S. equities. And there was a listing of the types of stocks, the types of equities that the Swiss National Bank buys when they're buying. And you can imagine what the names are, because they are pretty much the leading big cap, big name stocks that have an outsized influence on the market indexes like the S&P.
Right.
Stocks like Apple, Facebook, Google, Amazon, ExxonMobil, General Electric, Microsoft, stuff like that. And the Swiss National Bank, which is one of the smaller central banks in Europe, has been buying those names pretty heavily throughout the year, and especially so since the Brexit announcement.
Right.
And that's, those stocks, accumulation in those stocks will certainly drive the S&P 500 and the Dow, and even the NASDAQ. The Russell, not quite as much. The big central banks with, the billions of dollars that they have aren't going to be buying individual Russell 2000 type stocks.
Exactly.
But they're certainly going to drive the other indexes, and that's what's going on out there.
And so, yeah, and that kind of answers a question that Joe mentions. How about money flow into the U.S.? And yeah, a lot of it is those central banks. Um, and I don't know if the money markets are still showing a net outflow right now. That's the common, mom and pop kind of, well, not mom and pop, but the mutual funds. A couple of weeks ago, almost this whole year, they've been showing an outflow of funds. And so coming in to brace and to undergird the U.S. market has been the foreign central banks who do not have the same restrictions as the Fed on investing in U.S. equities. And so, yeah, so the point is basically on this chart is, yes, we have some negative divergence. However, as happens so often, the market can continue to push higher, even though and only be supported by a few stocks. We saw that. In fact, we saw that last year towards the end of 2015. We were getting really crummy, the black line is we were getting, a lot of stocks that were well below their 20-day moving average, but the market was still hanging in there, especially the S&P and the NASDAQ, until the Facebooks, the Netflix, the Googles, the Apples, and all kind of stuff, finally, once they started to implode, that's what took the market down. And so we're back in, are we back in a similar type situation as we were last year? I don't know. We'll have to wait and see how it plays out. So let's move on to the monthly. As you can see with the monthly, this goes back 15 years worth of monthly information here, as we can see. And I think, Mike, that on this particular chart, the divergences actually show up, even somewhat better than they do on the other chart. Now, of course, August is not over with yet, but July, we're pushing higher here. Nice breakout, pushing higher. However, the percentage of stocks above their 200-day moving average was still low. I did go to that, I did go back to the one website that we go to that has the where you can actually dial up the S&P and compare it to the percentage of stocks on the S&P that were below the that are above the 20-day moving average or the 200-day moving average, whatever you want. And one thing that was kind of interesting that we didn't see as much last year is that the percentage of stocks on the S&P that are above their 20-day moving average is down there around 50%. Now, it may have popped up a little bit today, but even that is starting to show, and that's where I was talking about that inertia that possibly later in the year could pull the market down. Now, the conspiracy theory is that the Fed wants to keep the market as high as possible going into the November election. Hopefully, with the desire to favor the incumbent party. But again, that's just a conspiracy theory, right, Mike?
Well, yeah, I guess. People have short memories, and I don't know how many people remember. It was just a few months ago when there was a news item that, Obama and the Vice President Joe Biden met privately with Janet Yellen, the head of the federal, at the White House. And a lot of people wonder what they talked about.
Yeah.
Certainly has never been made public except for the usual platitudes. And not hard, and I even said it at the time, and it certainly isn't hard to imagine that she was given her marching orders to not do anything to jeopardize the economy or the market prior to the election, because her actions since then would certainly seem to reflect something of the sort.
Yeah.
I mean,
Yeah.
she keeps reaching for more and more extreme excuses to not take any kind of action, and the only action that is taken is when the market goes through a little bit of a hiccup, like it did, for a couple of days after the British
Right.
the British news, that full support is thrown back into keeping the markets propped up. So conspiracy theory or not, we don't know. We weren't in the room, but it wouldn't be a surprise.
Yeah, I mean, they could have been talking about their golf game and their grandchildren, but that was
Yeah,
on that was on at an airport in Arizona, wasn't
yeah.
it? Sorry. Okay, I digress. I digress. Okay. And so,
we don't have enough time.
yeah, Joe says the RSP is outperforming the SPY, so breadth is still okay. Yeah, breadth has been okay here lately, Joe, and broadening ascending on moving averages from 2009. And yeah, we've had that kind of ascending, kind of broadening formation, Eric, on the charts going back to 2009, and again, it's those longer term pictures. They're not immediately actionable, but it's just something you file away, keep in your hip pocket, and say, okay. And at some point, it will be, something will come to fruition. So okay, so before we go to the charts, I wanted to take a look, and the two things I will highlight here are that both the NASDAQ and the NASDAQ Composite are now back in positive territory from last year's highs. And the NASDAQ itself, and when we look at a chart, you'll see a picture of this, is actually closing in on its all-time high, which I find really interesting. And oftentimes those all-time highs can in fact turn around to be the point from a technical standpoint where things not unravel, but the market says, okay, we've done our thing, we got to where we wanted to go, and now we're going to rest and turn back around. So we're looking at, the Russell's up 8% for the year, and the S&P is up 6.75% for the year, and in a normal year these are really okay returns, but it's been a wobbly year because at one point you got to remember that from the highs of last year the S&P was down over 10%, the NASDAQ was down over 10%, and so the recovery has been fairly interesting. FANG is doing well, yep, above their 8 days, and it's moving on up. Let's see, I've got Priceline. I need Priceline to get back down to where it closed out yesterday for another reason. So let's take a look at some charts here. Okay, here is the S&P. I'm just going to cover real quickly. The S&P came down and put it, we had basically worked within this range from about 2157 up to 2175, 76. We had been in that range for about 13 or 14 days. We get an initial pop down. The true sense indicator had already been working off its overbought condition, and the momentum had also momentum on a higher rate, and then it finally it broke to the downside, broke the 8, closed below the 8, but touches right at the 20 and puts in a very nice rebound. And as I mentioned on Wednesday night, is while yes, that is a bullish harami, it wasn't really much of a downtrend to reverse. And so that mutes the effectiveness of that particular candle signal. If we close where we're at or between where we're at and let's say 2174 for the day on the S&P, we will have a hanging man. As we learned a couple of Wednesday nights ago, that a hanging man actually turns out to be a better predictor of a continuation of an uptrend rather than a bearish reversal signal, as shown by where the buyers came in and then pushed it back up. So the buyers were still in control. And since we have pushed up to a newer high, but every time we push up to a newer high, it is getting itself further and further extended from the 8, the 20, and the 40-week moving average, similar that we see over here, extended well away from the 50, the 100, and 200. This time of year tends to be basically a weak time of year for the market, August into September. And you know, so far after the first week of August, you know, this year may be different, Mike.
Well, this year has been different. In fact, I'd say the past 2 or 3 years have been different. And you know, there are factors influencing the market. And again, we go back to the central banks and their policies and their actions that kind of make you have to throw all historical precedents just kind of out the window for now.
Yeah, exactly. And so here's the NASDAQ. NASDAQ had been on a tear ever since basically the correction, the flash crash of the Brexit, which is here on the 627, was when it finalized itself. And then it took off like a rocket ship. I mean, it's been going up you know, dramatically ever since. It did not go into the similar type holding pattern that the S&P did. But on, let's see, I want to say this was Monday of this week, it pushed up, hit the 1618 extension from this move from here to here. And that looked like, okay, that extension was going to basically hold as a level of resistance. This 4816, that is the all-time high on the NASDAQ. And so, as I say, we are only a stone, you know, just a whisper away from that all-time high. If the, you know, if the 1618 fails, then I would anticipate a pullback down into the 138.2. And the other thing that is going on there, and this was, we talked about this on Wednesday night also, it was this kind of potential negative divergence that becomes really more interesting, where prices move into a higher high. However, the true strength indicator and the momentum, in fact, do not follow into a high, and that can basically be a clue, an initial clue, like we saw back here, an initial clue that because we had some negative divergence going on back here in 2000, well, that's actually 2016, but it took 3 of them and actually made a new high before it finally turned over. And so that's where waiting, being patient, will eventually, you know, pay off for the individual investors. So as I said, if the 1618 fails, that increases the probability that we're going to go back down here and at least revisit the 1382 extension. And what we'll do is, if that happens, we will then draw in a new Fibonacci retracement that will go from this low here up to this high here. And let me change that color so it's a little bit more visible. There we go. So we've got that. And right now, nothing more to report on the NASDAQ. One of the other things to keep in mind, though, if you go back here and you look at these past upward thrust on the NASDAQs, they lasted 1, 2, 3, 4, 5, 6, and this one 7, 8 weeks before it finally bottom, before it finally went sideways. We are 1, 2, 3, 4, 5, 6 weeks into the current move. This move back here was 1, 2, 3, 4, 5, 6 weeks. And so that's what's happened in the recent past. We'll see if that symmetry, somewhere between a 6 to 8 week period on the NASDAQ, pushing higher. So we'll see how things work out with regards to that. Again, what are we looking at for a potential entry? Well, again, a nice, I would have loved to have seen a more in detailed pullback here, because we got the big washout here and then immediately a reversal and a gap up today. And so not a lot of opportunity unless one took the aggressive entry would have been right off the 8-day moving average. But we didn't have a reversal signal on the candle. So anything on the NASDAQ, Mike?
The one thing that really stands out to me, well, there's two things. On the daily chart, now, we do talk about it once in a while. I don't think we talk about it often enough, is using the 8-day moving average as a trend following, stop loss indicator. And I know that back at the end of June, our indicators for the early warnings alert triggered, and we put out the notice. Not too far off where this thing bottomed, around 4,200 on that particular day.
Right.
And only took a couple of days for the NASDAQ to get back to the 8-day moving average, and it has stayed above the 8-day moving average ever since.
Yes.
I have to admit my own fault. I get a little bit impatient. I try to take my profits early. I didn't stay with it myself. But for those who are more patient than me and don't have that particular flaw in their personality, the NASDAQ has given nobody a reason to exit that trade since then, because it has closed back below the 8-day EMA since it triggered
basically since here.
Right there. And you've been in that trade, if you've had the discipline to stay with it, ever since. And the results, if you're using a triple leverage ETF, if you were to check that on TQQ, I imagine the results would be pretty phenomenal.
Yep. And that does happen, and that's one of the things that folks can do who do work with the early warning alerts is oftentimes we'll kick out at 10%. I was utilizing the 618 retracement as a point to potentially kick out of. I did. That equated to about a 10-11% gain from an aggressive entry right off the, basically the lows here. But again, then we get this short time, not a great signal, but an okay signal bounce there. But as Mike was saying, if one would have applied that, you'd kind of still be in the trade. And, the NASDAQ is up 14% in the last 29 trading days. Now, and it doesn't matter how insane we think that is, it happens, and it happened in this case. And as Mike said, has still not given, an exit if the exit is based on a close below the 8-day EMA. So excellent point, Mike.
Yeah, and on the weekly chart, 6 weeks in a row of doing nothing but going straight up in practically a vertical manner is just an unsustainable move. And things that are unsustainable ultimately won't be sustained. There's going to be some give back at some point, and probably in the not too distant future, I would think.
Yeah, and so I only need price line to fall another 50 points and I'll be in good shape. So let's see here. Russell. Okay, Russell is And I had laid on the fib earlier today, that was from this high to this low, to see what the extensions are doing. It too broke up above the 1236 extension and literally thought, okay, this is the, and had a much better bearish type reversal pattern. 4 dojis in a row, followed by a big down day. That normally would be a big green light to the downside. We get right to the 20-day moving average, pierced it a little bit, came within just a whisper of the this 100% move, and then has rebounded the last 3 days. Retook the 1236 extension and then penetrated the 1382. If we get a close above the 1382, then there's a very strong likelihood that it will then penetrate, or at least get up and approach. It doesn't have to be to the penny, but approach the 1618 extension on the Russell. Now, where would that put it? Well, that would put, look over here on the weekly chart, that would put it all the way back over here, back up into the resistant zone that was, that was around the high from last year. As we can see, let's take a real close look at things. We have negative divergence on the Russell, and you have to say to a fairly extreme amount. Same thing on the momentum. We have negative divergence on that even as we're pushing up to this new high. What are we doing here on the weekly? Well, the true strength indicator has in fact pushed up to new highs, but however, the weekly momentum has not pushed up to new highs and is showing negative divergence. One of the things, Mike, I've been looking at over this week in trying to analyze what the market may be doing is taking a look at this high points and past high points on the TSI and what was the reaction of the market. And this is going back to 2007 on a weekly chart. And as you can see, TSI hasn't, it doesn't get above 50 very often, but when it does, it tends to predict that a rollover or some sort of a pullback / correction is in order. And so as you can see, it hasn't quite pushed up through the 50 yet, and sometimes it just stops there, and that's when we start looking for those weekly, if the negative divergence on the daily charts is important, the weekly divergence is even more important, even a stronger indicator. The other one that I wanted to show just real quick was on the NASDAQ. And yeah, well, no, it wasn't. Okay, NASDAQ on the weeklies is showing, way up here in the not quite to the 50 level, but it is extended. And then on the, but again, same thing for that. It can still pile up and move higher, but it doesn't spend a lot of time above that 50 level. And that's where we look for those setups to, for potential setups to the downside. I think the one that was more indicative was on the daily chart for the NASDAQ. Yes, it was. Okay, there we go. The weekly chart had gotten to, where it had seen past highs before, and this is going back to 2013. And as you can see, it had reached its daily, about its daily high up here, about 66.5, and whenever that happened in the preceding few days, there was typically at least a good pullback, and oftentimes an orderly pullback, back into a stronger level of support, which then worked for a good bounce from there. As I was saying last week also, on many of the stocks we've been watching, is that we have been having a divergence between what is showing on the daily chart and what is showing on the weekly chart. On a lot of the stocks, the TSI and momentum were already down here at their lows, but the true strength indicator and momentum on the weekly charts were sitting up here, towards their highs, not showing that they're ready to turn over yet, or looking like they were almost ready to turn over, I should say. And so, okay, Mike, any comments on either the NASDAQ or anything else we've chatted about? Mike?
No, nothing. I'm sorry, I had myself muted. I don't think there's really anything to mention we haven't commented on already.
Okay.
The only thing I don't think we've looked at for a while is the NYSE composite, to see how that maybe compares to, the other more common indexes that we're looking at, because sometimes there can be subtle differences there.
Yeah. And so, well, there you go. The NYSE is a long way away from past, the highs from last year, and again, it is in fact didn't push up into even the highs that we had a few weeks ago, and so I would say that, on this index, that it's showing weaker signs than the other indexes. And Mike, what would be your takeaway on that?
Well, it's a bigger index than the other ones. It represents, I think, about 3,300 stocks, and certainly more democratic because it's not cap-weighted or price-weighted,
right,
like the NASDAQ and the S&P and the Dow, and more democratic that way. I think it gives a better view of the overall market.
Okay.
Getting a certainly not influenced by a handful of heavily favored stocks the way the other indexes are. And the reason I mention it is because I know, again, from some reading just last night, that in the past nearly 2 years now, since the Federal Reserve stopped the quantitative easing stuff, which was around October 2014, nearly 2 years ago now,
right,
we're still on this particular index below the highs that were put in back then, and it really hasn't moved all, on a net basis since then. I think it's down about 1 since October of 2014.
Yeah.
It's really kind of gone nowhere. I mean, despite all the ups and downs in between. And again, nothing that's actionable as of today or this week or next week, but a good bigger picture perspective, I think, to tuck away in the back of your mind, knowing that this thing has been going through possibly a nearly 2-year-long topping process.
Yeah, exactly. And we will see if this, which way this leads us. And as you said, it is a much more democratic index because it's not weighted. And so Eric makes a statement that things will go down faster whenever that may be. Yeah, we don't know where it's going to be, but they tend to go down much more faster than they go up. And we'll see where it goes from here. So any questions on the market?
as one parting comment or observation, because I can't stick around for the rest of the webcast,
Yeah.
I was having a conversation with one of my neighbors here a couple of nights ago, and he's very involved in real estate, the private equity, commercial real estate.
Right.
And that's how he makes his living. He's been doing it for decades. And he is, at least from a real estate point of view, really, really afraid of what's coming, because it's going to impact him and impact his business, and because he's lived through a few business cycles before.
Yeah.
And it should be a given that the stock market and the real estate markets, while they aren't always perfectly in sync, tend to be pretty strongly correlated with each other. I mean, you're not going to see a big move in one direction in the equity markets and a big move in the other direction in the real estate market. And that was the nature of that conversation.
And so, yeah, Scott brings up a question. He talks about, we're so bearish, and I don't really consider ourselves bearish, Scott. I mean, we have been participating in the rally, and have taken some profits out of that. And right now, we're not arguing. We're saying, hey, we're in an uptrend. I'm looking for pullbacks to trigger long trades. And so it's, but at the same time, if there appears to be storm clouds on the horizon, it's something to at least be aware of. Yeah, I think so.
Yeah, I would. My comment to that is exactly echoes yours, Dennis. I think in the short term, you play what's in front of you, but in the bigger picture, longer term perspective, and we're talking about several months or even years down the line.
Yeah.
I don't disagree, Scott. We do sound kind of bearish because the picture in front of us lends itself to that. Keeping in mind the time frame that we're referencing when we do sound bearish. Short term, I think we've been pretty bullish. Longer term, in terms of core long-term investments, 401k money, I think you have to have maybe a different perspective on the longer-term outlook.
Yeah.
And hopefully you're not focusing or mixing your time frame references too much when making those judgments.
So, path of least resistance, and I'll let you go, Mike.
All right, I'll talk to you soon.
No, I said, give me your path of least resistance, then I'll let you go.
Path of least resistance, short term up to sideways.
Yep.
And in the very, very longer term, down.
Okay. I would like to see, for me, basically, I think the path of least resistance, at least interim, probably through at least the next 3 to 4 or 5 months, is up. I would like to see a pullback into a uniform pullback that would give us an opportunity to get long, to participate in this a little more, and again, or even a sideways move, and we'll see what's going on there. And so Scott says, I haven't seen the bullish trades, only the bearish sentiment. I think we are going to Dow 22,000. Okay. And so, no, I mean, is that possible? You betcha. Sure it is. And so, okay, what are we looking here? Mike, thanks a lot, buddy. We'll see you latter part of August when we're down in Dallas.
Okay, sounds good. I'll talk to you soon.
Okay, here's where we're sitting this week. We had 2 good trades on the strategy number 3 with Tesla. Those who participated in that. And then we also closed out our gold trade, the seasonality trade on gold. We had one little hiccup where our WOR trade hit its stop loss. So basically, CUM for the year, 21%. Strategy number 3 is still pushing really nicely. Strategy number 2, 37, and strategy number 1 is about 2.4% down for the year. My objective through the end of August is, again, I've been paralleling this, my P&L line very nicely, but I really want to get this gap closed back up so I can hit the end of the year with my 40% return. And we will see how that goes. And let's see here. A couple of other things. What else we got going here? This is one of the, and I want to address something really quickly on this particular slide, this is our Tesla strategy 3. On the first two positions we bought in September of last year, we've generated over $14,000 worth of credits coming into the account on this. Our initial investment was about $9,010. And so we have more than paid for, paid the cost basis on this. Basically we've been averaging about $325 a week on it with a 7.78% win-loss ratio, generating about $13.51 per month. Now, this self-calculates, the spreadsheet I have, to show me what's required on a weekly basis, given there's only 24 weeks left in the year. This changes on a more or less a weekly or a daily basis. I've been falling a little bit short on the average, but part of that also takes into account back when we opened the trade back in 9/29, we took about a $1,500 loss on one of the positions that we had opened, the long leaps on Tesla, and this number here captures that. So it's actually paying greater than, so that number there required each week captures that, to be able to pay that off also. And again, that's what I'm pushing for. This number here is what I currently have invested on that particular trade. So I hope that helps answer the question a little bit. Here's the strategy number 2, option gold seasonality. We bought the position back here, basically on just before, because expecting a July-August move on gold, and we got it nicely. Matter of fact, it bounced too quickly on the initial part of the trade, and so we closed out a piece of the position. We got into the position for $1.49 on this spread. We had 12 contracts on the spread. We took out a quarter on this day here when it bounced up here. We took out another quarter here when it hit this new high above 127 for $3.10. It popped on up, and then it fell back into this support area about 125. I was putting in a new stop loss at $2 and a trailing stop at $2.50 on the spread, which would still get me out profitable on the whole thing. I fat fingered one of the quarters position and put it in that if it was above 250 to close, or above 250 to close it out. And so that was my FF, stands for fat fingered. So I closed out a quarter at $2.85, and then just this past week when we hit back up here at 130, we closed out the rest of the position. This was a $5 wide spread for $4.50, and so over from June 22nd, we pulled in about $2,097 for about 117% gain. Tomorrow we'll have the BAM meeting at San Jose at the Masonic Temple. I'll be presenting, but Lyle Wright will be also presenting on 20 habits of successful traders. Looking forward to seeing that. Next Wednesday we'll be talking about fixing bad trades. I'm still working on these videos. And just a reminder, active trend trading system, what to trade, when to enter, when to exit, what strategy to use, and what to expect. I'm a firm believer that what's most important is to learn a system, and then you attach your strategies to that. And I have 70% of my funds attached to the stock and index ETFs, basic options 10%, and now about 25% now in the wealth building. I increased my size in Tesla because it was paying off so well. And here's what we get with the two services offered, and I'll just go through that quickly. And so, okay, that closes the prepared. Closes the prepared aspect, and now we will take a look at some stocks briefly. Okay, let's see. Okay, there were some. Oh, yeah, Gino has TRSO and Tesaro. Okay, Tesaro just exploded higher after, well, this was actually pre-earnings. That's very interesting, Gino. We just had earnings this day here. Big buy here. I would have to check the news to see what happened here. Tesaro is one of those stocks that can show some explosive moods, but it looks to like it's basing here. Is there a buyout rumor on this or anything? Because at this particular point, I would be waiting for to see if it stabilizes up here after this huge move, and not sure. Okay, and then look for a bounce off either the 20 or the lower Keltner channel. If it stabilizes here between the 83 and the 96 level, it may go into a sideways move, and that 85, 83 would be a buy point. Or if we get a good candle off the 20-day moving average. X actually, X is not a bad, which is U.S. Steel, is not a bad stock to have on your watch list almost all the time. Because it does this kind of thing quite often. Is that it's like its fundamentals are absolutely awful, but it's got these nice little moves that are predictable. It shows some good patterns, and as you can see, as it rolled back up on this one pullback here just after earnings, it popped back up, and it's moved like 77% over the last 10 weeks. And so it's a good one to keep on your radar. And so what I'd be looking at this point, you can always take the trade basically on a pullback to the 8 or the 20, but it's very much extended. I'm always cautious about some of these later pullbacks to the 8 or the 20, especially when I'm well extended away from my weeklies. Because oftentimes what you'll see happen, it'll push back up into that resistance area, but then pull back down again. So it needs to break up through that. If it were, if this had sold off down into here and then did that, a bounce off the 20 or even down here at the 21 or 22, I would feel more comfortable about the trade. Steve asked, or Eric asked about, let's talk about Tesla real quick, and then I'll get to PayPal, Tesla. Yeah, Gary, what I'm looking at on Tesla is if we're holding right there, what I'm looking at is either the 232.50 call, next week's expiration. You can get about $2.50 for it, or just go ahead with a 230 call. I may only do one contract simply because just because of the current market stability, which way it may go. Tesla's report out on earnings was, of course, they're burning cash faster than they were, but Elon Musk is talking very fast to try to keep things, I won't say to keep things afloat, But he, about, higher levels of productivity in the future, their battery plant up in around Reno, and then of course they are buying Solar City. And it looks like that deal is going to go through. So that's what I'm looking at when I finish. When I finish off here, I'm going to take one more look to say, and I'll look at the intraday chart to see if it's in a place where it would make sense to sell the 230. Tesla, let's take a real quick look at, and the PayPal. Okay, PayPal basically got into a put position about 4 days ago when it was basically pushing back down off of the 820 and this support here at the resistance at the 37.47 level was holding. Eric, what we've had is we've had a reversal on that. On those smaller, option trades, because I'll basically try to trade, less than $2,000. I will let it go to my 25% stop loss, simply because it's one of those where I just want to put the trade on and then see what it does. And at this point, I could have basically closed out yesterday on this move higher, and of course on this move higher today. It has not triggered my stop loss yet, so I'll hang on to it for a little bit more, for a little bit longer, to see if it's going to basically reverse down off of this. It's actually getting a pretty nice move, so that's one of the things. And so that's where I'm sitting with the PayPal, and that's the way I try to do those option trades. I'm willing to go, a 25% loss to off, and my first target for a profit is 25% gain, and my second target then, of course, is the 50% gain on a straight directional option trade. And let's see, NTES, excuse me. So yeah, Dorothy, NTAS may be starting and going into a pre-earnings run with a potential of running all the way back up here to the 210 level. That would be a move of about 4.7, 4.5%. It does have earnings coming up here on the 8/17th. So from a daily chart, it looks really good, but this is a great example of the divergence between the daily and the weekly. The dailies look very positive, like it wants to run on up. The weeklies, on the other hand, look like they want to turn over. And so that's where I'm saying that if you took this trade bouncing off the 8, my profit target would be probably just short of the 210 level. So, okay, any other stocks, guys? If not, I'm going to sign off and finish the presentation for the BAM tomorrow. So thanks for joining us. Have a great weekend. Next week here, I think I will be in Boise or Idaho Springs for the, or Idaho Falls for Friday's webinar. So have a great weekend. God bless everybody.